all of my savings that I don't need to cover my bills is in crypto. And I've been adding because we're at that point where the economic inflection point is going to change, and that tends to be quite good for crypto. So I don't expect everybody to do that, because liquid net worth is different to entire net worth. I've got houses that I don't have mortgages on. I have an income. So the amount of risk I'm taking is actually not as big as it sounds. I'm like, this is the best risk reward I've ever seen in my entire life, and the best one any of us will ever be given. And that actually proved out to be the case. So if you think about it, what is macroeconomic investing? It's using the economy to understand the direction, the future direction of assets. Why does that happen? Well, simply, if the economy is booming, people have more money to spend, and it tends to be positive for assets. And if the economy is slowing down or negative, then you tend to find that asset prices don't do as well. Some assets work the opposite way around generally. So usually when things are slow, bonds do very well, but equities do badly, for example. And it shows you that as soon as you make these things year on year, they look identical to the economic cycle. And that's the kind of big unlock, is realizing the economic cycle drives all asset prices. If you know where that's going, you can kind of make forecasts about asset prices. Nothing is foolproof in this world, right? All we're trying to do is get probabilities in our favor to try and roughly assess. But here's what's simple, is if you look at a chart of the ISM over the last 50 years, it goes up and down in cycles. The economic cycle, we all hear that term. What it means is kind of, that if it's rolling over, it's likely to go all the way to recession. It doesn't always happen, but your probabilities are high. And once you're in recession, it tends to start picking up again, and that gives you the green light to maybe buy some of these things. So in a very simple terms, you're looking, the 50 line in the ISM is roughly where it goes to contraction or expansion. If it's coming down and going through 50, you start to worry about recession. So currently, while we're doing this, I think the ISM is somewhere around 52 and on its way down. So we're starting to think, there's probably a recession coming. And when it comes up through 50, you're kind of being given the green light. So the forward-looking stuff suggests we're about to go into a severe recession. So now you need to figure out, well, what are asset prices pricing in already? Because you can't trade on today's news. You need to trade on tomorrow's news. And really speaking, you need to trade 6 months out news. If I look at the S&P 500, it's already pricing in about 42 in the ISM, so a full recession below that 47 level. Could it go a bit further lower? Yes, because my forward-looking indicators suggest the ISM could get down to 40 or so, maybe a bit lower. But we're kind of in the right zone to say, actually, a lot's been priced in. Could there be one leg lower? Maybe. But that means that as an investor, your spidey sense should be up saying, hey, is the opportunity coming here to buy when everybody else is fearful? So again, my forward-looking indicators suggest that the economy picks up maybe in the first quarter of next year. So in which case the markets will start to forward look some of this. So it's actually a little bit of a tricky point in time today, but we're getting very close to the time where the markets will start saying, okay, I can see what's going to happen here. The economy is going to go into recession. The Federal Reserve will stop raising interest rates, as will the other central banks. And chances are things start reversing again. So you kind of want to have cash ready, and then you want to see what the economy does, and then start to see, hey, are bond yields coming down? Are the Federal Reserve going to stop raising rates? Those are kind of signals that the future economy in a year's time is not likely to be as bad as what we're seeing coming in the next 3 to 6 months. And it's that transition that becomes very interesting for investors. So, basically, if you're young, you should be risk seeking. If you're old, you should be risk avoiding. It's as simple as that. So if you are young, you should be looking at, okay, how do I take advantage of the sell-off in crypto and the sell-off in stock markets and technology stocks? Because those are the things that will drive returns over the next 10 or 20 years. But if you're older and you're retiring, you want to stay in cash for longer. you don't want to take as much risk because you don't have an income. So your grandparents don't have an income anymore, so it's just their pension. So they need to be careful, very careful with their pension. Their nest egg has to be protected at all costs. So I don't see the really terrifying outcome. Of course, some companies might go bust. People will lose their jobs. Maybe some weaker economies will suffer badly. But generally speaking, I'm not picking up, oh my God, we've got a debt crisis coming or something really bad. So I think it is different. And so a lot of people are expecting the next leg down. Is this going to cause the crash? I mean, the market's already down. I mean, the Nasdaq's down 27%. It was down 35% or so. It's pretty much crashed once already, but people are like, can it go down 50%? Because they look back at 2008 and 2001 and said, see, it can do that. When you go back to other recessions like 1990, it was a 20% correction. It depends on how much risk you want to take and what time horizon you're investing in. If you're young, the single best risk reward is crypto, because it's the only market that goes up 10, 20, 50x, while the stock market may double, may go up 200% over the next 5 years, but crypto market does a lot more. So if your aim is to take risks to accumulate wealth, then crypto. I prefer crypto as a bet because I think it has a better risk reward than other markets. But you have to suffer these drawdowns, and a lot of crypto is down 60, 65%. But if you're less risk seeking, you might just want to buy equities. If you're slightly more risk seeking in equities, you might want to buy technology stocks, because technology is not going away. So I prefer technology and crypto overall. All of my savings that I don't need to cover my bills is in crypto. And I've been adding because we're at that point where the economic inflection point is going to change, and that tends to be quite good for crypto. So I don't expect everybody to do that, because liquid net worth is different to entire net worth. I've got houses that I don't have mortgages on, I have an income. So the amount of risk I'm taking is actually not as big as it sounds. And first time around 2013, it was significantly less because it was riskier. We didn't know, was this technology going to survive? Was it going to be banned? All of the questions that have now mainly been resolved, we didn't know that back then. It's like, here's a bet. I think I wrote the first ever macro strategy piece on Bitcoin in 2013. And I said, it was $200 at the time. I said, listen, if we value it like gold, it could be worth $1 million. So let's assume I'm an idiot and discount myself by 90%, still worth 100 grand. And therefore at $200 with the upside, you could lose all your money, but the upside was 100,000. I'm like, this is the best risk reward I've ever seen in my entire life, and the best one any of us will ever be given. And that actually proved out to be the case. I think people either ignored it or thought this is interesting, and people got involved. Because, our job is to look for really interesting opportunities that other people haven't seen. So a lot of people weren't so skeptical. The skepticism came later in about 2017 when retail investors got involved. And then a lot of people didn't like it because the returns had been so big. They're like, at all times, it's a bubble, because they didn't understand how this kind of very powerful technology worked. So those voices of dissent were much bigger in 2017 all the way through to today, because it's questioning people's very system of understanding of financial markets and what is technology and how do they work. They kind of think it's crazy that a bunch of us are happy to see the market go down 70% and think that's normal, and then go up 20x. They don't see those kind of things, so they don't understand it, so they're kind of fearful of it. There's literally almost too much to keep on top of. So, how do you pass through all of that excessive information? You start looking, okay, what are the main chains that the activity takes place on? And the main place is Ethereum, and then places like Solana, Avalanche, Polkadot, and a few others. So that's how you kind of filter down. You see all of this stuff going on. You're like, oh, this is overwhelming. But then the great thing is what platforms they're being built on, and then we can invest in the underlying platforms and protocols. Crypto is a true global asset. It's the same for the person in Dubai as it is for India, as it is for Kiribati, as it is for New York City. It's the same thing, right? We've never had that before. And the access to it, yes, you could trade foreign exchange, which is a globalized asset, But it's actually not that easy for people to do, but this is super easy. So we've never had this before. The most powerful thing that I ever created was a network. And I didn't really realize that. And my network started at Goldman Sachs and maybe before that. And then the people that came into my network along the way, if you give them good karma, you're good to people, you help people. What happens is it builds, like in crypto, this network that has value to you as a person and also to the other people. And so even in this digital world, having a network of people around you, don't have to be physical, that you help out and they help out you, you don't realize the opportunities that's going to bring, because you'll be smarter, you'll see more opportunities, and you'll have more opportunities. And that is a really powerful thing. When I bought Bitcoin in 2013, I was super early. And I had a long-term thesis, and I knew it was going to be volatile and it could go to zero. So the idea was, I bought it, it went up from 200 to 1,000 in 6 weeks. I'm like, oh my God, I've never had something do this before. Then it fell 87%. And I kind of like, fine, I knew it could go to zero, but I think it's got a much bigger upside. And my thesis was 100,000 up to 1 million. And then it kind of did nothing for a while and then took off. And there were the forking wars happened in Bitcoin back in 2017. And I got confused and worried that, okay, I don't know what this is going to mean. Is this all going to fall apart? And I was now up 10 times my money. So I took profits and I felt like a god. And then it went up another 10 times. And I was like, that's okay. I've made 10 times my money. I can't argue. Then it crashed again. And I eventually knew that crypto, and particularly Bitcoin at the time, and macro would merge in the next recession. And that I really wanted to own it when it got sold off in a recession. 2020 comes along and I really piled in with as much money as I could possibly scrape together. And it turned out to be a phenomenal bet. I went back and realized if I'd have just kept my initial investment and not done anything else, I'd have made 5 times as much as I did by trading it. And then I worked out one more piece of magic, which was if I'd actually bought crypto every time it did these big sell-offs and just added to my position in the same size I had originally put on, I'd have made 25 times as much money. And on paper, it looked like I was a genius. But the reality was I was a fool. And so that was a huge lesson for me, both good and bad.